There have been some tax law changes, and tax law changes can be taxing to both financial planners and the public alike. So let's walk through some of these. One of the big areas is inherited IRAs. Let's say that you inherit an IRA from somebody that's not your spouse. It used to be you were able to spread out distributions over your life expectancy. So you're 30 years old, have a 50-year life expectancy. You could spread it out over that 50 years and take a little bit each year rather than taking it all at once and paying taxes on it. Now the government wants their money a little sooner. They're going to a 10-year period for most people. That could be a problem because you have to bunch all those taxes up sooner. Now you could wait till the end of 10 years, then you could have a real tax problem on your hands. Now the exceptions are this. Let's say if you are less than 10 years younger than the deceased account owner, then that doesn't apply to you, or chronically ill beneficiaries, disabled beneficiaries, or let's say that you're a minor child. You can wait till the age of majority, then the 10-year clock starts ticking. Now, inherited IRAs prior to 2020 are not affected, so don't worry if you inherited one earlier than that. Just after 2020 is what counts. Another thing's changing. Let's say that you're getting close to retirement and you're going, oh wow, I'm turning 70 and a half soon and I have to start taking required minimum distributions. Well, you can actually wait to age 72 now. Now, if you turned 70 and a half in 2019, you still have to go with 70 and a half. But for people that didn't want to pull money out of their IRA quite so soon, it's going to be a bit of a reprieve for them. Another thing, if you're a parent and you're looking at adopting or having another child, you can pull up to $5,000 from retirement accounts upon their birth without any kind of penalties. So that's a good thing for people that are looking for ways to pay some of those expenses. Now, the other thing that you can do is this, which is interesting, is you could never contribute to an IRA past age 70 and a half. Now they've changed that. You can actually do that. If you have earned income, you can continue to make those contributions. Watch out though, because if you're using QCDs, which are qualified charitable distributions, they can offset each other, so be very, very careful with this one. Let's say that you have an IRA and the beneficiary of your IRA is a pass-through trust or a conduit trust. You better talk to an estate planning attorney immediately because it may not be the great thing that it used to be. Another thing that you might want to be thinking about is, well, let's say you have a 529 and you have kids in school and maybe they're being homeschooled. Well, now you can actually put money in a 529, use it for homeschooling, registered apprenticeships, up to $10,000 of loan repayments for student loans as well, also for siblings. So that might be helpful for people for schooling issues. So a lot of things going on in this new tax law that may be beneficial to you. Make sure you get with a planner and check it out.